Hey, everybody, welcome back to the show. Today, I'm so glad to have our guest, Clay Allen, on the show. Clay, thanks for being here.
Thank you, Sujata. It's a pleasure.
Awesome. So, everybody, Clay Allen is a senior director in the Atlanta office for Old Capital. With over 20 years of commercial real estate experience, Clay is focused on providing debt and equity solutions to his clients nationwide. Prior to joining Old Capital, Clay asset managed a $1.5 billion portfolio of multifamily assets, totaling nearly 10,000 units across several major Southeastern markets. He's also spent several years with regional banks and GE Capital, where he underwrote portfolio and CMBS debt, as well as joint venture equity investments. Awesome. So, Clay, today we're going to do a deep dive, as we spoke about, into what's happening in the multifamily lending space. So, why don't you tell us kind of your overview of where things are at with lending right now? And we'll take some, I might, pause you for a minute to just explain some things, some terms and stuff for our listeners.
Oh, absolutely. Yeah. And thanks again for having me. The overall nature of the multifamily lending market today, as we record this, is I would just, in one word, say robust. I mean, there's plenty of capital that's chasing deals, both on the equity side and the debt side. So we have a Federal Reserve that it's positioned itself to where they want to keep rates low. And that's, keeping interest rates that's being passed along to investors very low as well. And so on top of that, you have, I would say, a climate where asset values are increasing at a pretty rapid pace, right? We're seeing it not only in multifamily, we're seeing it in the stock market and our own homes, and then also even the cryptos. And I know we had a pretty big correction over the past weekend or two, but yeah, we're seeing just a lot of capital flooding the whole market, and lending is right there with it.
Okay, awesome. So, you before the call, we were talking about sort of the difference between agency debt and bridge lending debt. Can you give the listeners an overview of, first of all, what is agency debt?
Yeah, sure. So agency debt, when you hear that term, think Fannie Mae and Freddie Mac. Those are two institutions, without getting to the history of them, but they're two institutions that were created by Congress at different times. And the whole purpose of them is to provide liquidity to the housing market. That's both single family and multifamily. Multifamily kind of came later in at later stages. But multifamily is a big piece of their business. And so they were created to provide liquidity. And because of that, they have to abide by certain, we'll say, thresholds or standards by which you get a loan. In other words, you could say, or they'll offer maybe 75 to 80% loan to value and hold to a minimum debt service coverage. And it might be dependent on the market or a tier. So they are there to, again, provide liquidity. They sell that debt off, the loans that they make, they sell it to investors, and investors kind of reimburse them, if you will, and they keep the machine going. So they are, generally speaking, I would call it the gold ticket to multifamily lending. I mean, that's kind of where you want to be if you're an investor. It's long-term, fixed rate. In many cases, you can go floating, but long-term fixed rate, low cost, non-recourse debt. Non-recourse being the operative word here, the most important term. You go to your local bank and you're going to be signing a guarantee, right? If you get a nice agency loan, it's non-recourse, so you don't have to worry about signing a guarantee on that. The agency lenders will be looking to the property itself for repayment, not your own personal assets, and so they're going to do a very astute underwriting of your deal from historicals, the T12, T3 income, and they're going to say, this is what we can lend on. This is the operations as it is today, and this is where we feel comfortable lending. So that's agency. Now, contrast that with bridge, and there's other loan products out there, but we're going to pick bridge right now because they are kind of the flavor of the month. Non-recourse bridge lenders are lenders that are a number of different lenders that are backed by, we'd say, debt funds or mortgage REITs, private capital. So they're not regulated like Fannie Mae and Freddie Mac. Because they're not regulated, they have the ability to go higher in the stack than, say, the agencies do, or they're not necessarily beholden to a minimum debt service coverage. Each one will have their different standards for what they underwrite. So what you have today is a climate where there is a lot of deal activity. You have a lot of equity chasing deals, and deals are coming on the market. We're kind of starved from 2020 when there's a big pause in the action, right? And so a lot of capital chasing deals, and bridge lenders they're kind of waving their hand saying, hey, listen, we are able to go up to say 75% loan to value, and we'll also provide you upwards of 100% of your capital budget. And it's easier to make that underwrite with a bridge lender than it is with agency lenders these days. So so that's where we're seeing most of the action with the bridge lenders.
Okay. And what sort of considerations would you be, anticipating that syndicators and operators would need to be taking into consideration when, considering agency versus bridge lending right now?
Yeah, so it's a great question and something I should have touched on before, because you can tell from what I just discussed, they're two totally different approaches. The agency lender is looking for a stable property, right? They're underwriting stability. So if you have pretty much a stable property, or even if it is a value add, you can do that. You'll just be more than likely raising more equity for the value add play on an agency loan. Bridge loans are kind of, the purpose is in the name. It's meant to bridge you from one point to the next. And what I mean by that is they're really geared for value add or to correct an issue at the property. So an example would be your traditional value add play where someone comes in and buys a 1995 built property, hasn't been touched, and they want to do a full renovation, and they'll get a 2 or 3 year bridge loan where they will have time to execute their business plan, pump some life into the property, get it stabilized by month 36, let's say. And at that point, that's when you go shop for the permanent loan, most cases with a bridge or with an agency loan. So that's the design of the bridge lender. I would say today it's a little bit different because the proceeds are there for even stable properties or light value add. So you have a lot of investors out there who are going out and buying light value add deals, or in some cases even stabilized deals with bridge debt. So that's all fine and good, but one word of caution on that is that 2 or 3 years from now, you will be in a refi scenario. And while we have been given indication from the Federal Reserve that rates are expected to stay low for the next couple of years, we don't really know that. And I'm not sure exactly how much control the Federal Reserve has over that anyway. So so if you're, if any of your listeners are going out looking to buy deals today, just know that that's always a risk that you run in any market, that you will have a refinance scenario in fairly short order.
Okay, so would you recommend, the issue is that when you are going to be taking out the bridge debt with agency debt, that the rates will be higher than what you're currently paying for the bridge debt, or what would you say the risk is?
Well, that's certainly a risk, is that, let's say we have a shock to the system. Let's say that inflation, we're really looking at inflation numbers these days, right? Every month. And let's say we have another 2 or 3 bad months of high inflation, 4 or 5% in the CPI and other indices. At some point, then Treasury holders get very scared, and they might start dumping the Treasuries. And it might be more difficult for the U.S. Treasury to sell the 10-year notes and bills and the bonds, causing rates to rise. Now, if that happens, then yes, you will have higher rates when you go to refinance. But you also probably have a scenario where values become lower because it's more expensive. Your cost of capital is higher. And you may, and I'm not saying this is going to happen, I'm just saying these are things you got to think about as an investor, as an owner. You may have a scenario where the agency lenders today, they might be saying, yeah, we'll do 80%. Tomorrow, they might be saying, we don't feel good about this market. We're going to say 70% loan to value. So, I say all that because a lot of us who underwrite deals, we will underwrite various scenarios. Like we'll stress the property. And it's usually on, let's say, rent growth or occupancy. And that's all fine and good, and it should be done. But we also should be looking at capital events like refinances, especially if you have 1, 2, or 3 years from now. So what happens if the market kind of falls out and lenders are saying, I'm pulling back? What does it look like to try to refinance your property in 3 years at a 70% loan to value, or even worse, 65% loan to value? Are you writing a check? Are you coming out of pocket? Are you doing a capital call for your investors? Those are the kind of things that kind of would keep me up at night if I were closing in this market.
Yeah, certainly. So that's, I think, a really good point, that stressing not just rent growth and occupancy, but stressing what the refinance event is going to look like if you are purchasing with bridge debt. And that's I'm sure are there any sort of general kind of recommendations you would offer? I mean, just like looking at the amortization schedule, the interest rate, what else should people be sort of stressing?
Well, as far as stressing, I don't know that there's many other things I would look at. I mean, I think rent growth and occupancy obviously is something that you always look at. Interest rate risk, just cap rate. That's what, actually, I'm glad you asked now, cap rates, right? We have traditionally underwritten, say, 10 BIP increases per year in the cap rate when you're looking at a reversion scenario in your underwriting. So 4 or 5 years from now, you're just going to assume that cap rates rise 10 basis points per year. That's what we've done traditionally, as far as I can remember, and I've been in the business for a while. Because we've gotten this environment where the Fed's saying we're going to artificially keep rates low for some time. I've heard a lot of people saying we're going to go down to 5 bips per year, 5 basis points per year, or even keep them flat for the next 4 or 5 years in their underwriting. I would definitely caution against that, only because what we just talked about, the sudden rate movements and just the deterioration in the market. And keep in mind, we're just seeing a rapid increase in the valuations today. So who's to say it can't kind of whipsaw back at some point? So anyway, that's one other area I'd stress to take a look at. Now, I want to kind of correct a little bit here. It sounds like I kind of poo-pooed on Bridge, and that's not what I wanted to do necessarily. I think it's a great product, and I think it definitely fits a purpose. And they are very, very competitive terms these days. So what you might find with a bridge lender these days is, it's interest only, it's floating. So you have 2 to 3 years of IO, and you'll also have some opportunities to extend that 1 or 2 years. Usually it's a full 5-year term. That'd be a 3-year initial term with 2 extensions. And the rates are, typically a LIBOR base at a floor rate of 25 basis points, and very competitive spreads, to the point where it's very competitive with the terms that you get with agency. So it's a great product. It is non-recourse also. After you're say above 5 million, and really I say 10 million above is the sweet spot for bridge lenders, it's non-recourse. So you're not guaranteeing the deal. So keep that in mind. It's a great product from that angle. One would have to look back, though, as well, if you're doing your full due diligence, and look back to even as recent as COVID, and you can look to see how quickly a bridge lender can exit the market if needed. If things get bad, keep in mind, these are debt funds, mortgage REITs, private capital, and one day they could just say, we're not going to close, we're not going to lend. So that is a risk. If you have a 60-day period of closing, you're in due diligence, and all of a sudden, the world kind of starts to slow down or fall apart. You might have some lenders, maybe the one that the horse that you've picked to fund your deal. They may say, we're either out of the deal completely, or we're going to retrade you. That is a much less risk on the agency side, again, because of their charter. Their charter is to provide liquidity to the market. So.
Okay. Yeah, there's so much to touch on there. For a lot of our listeners, let's just kind of maybe review some of the sort of basic lending requirements that, we talked about, like debt service coverage ratio and loan to value. Could you just give us a general overview of those things for people who are newer to this?
Yeah. So the loan to value, just how it's all measured, or do you just go through some of the terms?
Yeah, just go through some of the terms and
Okay.
what they mean, and maybe how they're different, how they would be different in debt or in the bridge lending world versus Fannie Mae and Freddie
Yeah,
Mae.
sure. So let's kind of start first with the sponsor. Who makes an attractive borrower for these different loan products, and we'll go with agency. So agency right now is looking for experienced sponsors, and that could mean someone who has no experience, but they've partnered with someone who's taken down 3 or 4 or 5 properties in the past, and they've held them for maybe a couple years, but at least one of them for a couple years. So they like experienced sponsorships. They like to see balance sheets along with the sponsors. So your personal financial statements collectively as a group it needs to be a minimum of 10% in liquid assets, 10% of the loan amount in liquid assets. That being, say, cash, marketable securities, cash value of life insurance. It also needs to be roughly 100% or the full loan amount in net worth. So again, collectively, the net worth of your group, sponsorship group, needs to total the loan amount or greater. So that's kind of what they're looking for. And for general terms from them, you generally see 5, 7, and 10-year loan terms, but they are flexible. You can go as high as 30 if you want to, but nobody really ever wants to do that. But generally 5, 7, and 10 years. So kind of longer term fixed rate debt. Rates today, as we record this, you're probably 3.25%, and that can range 3/4, 350, depending on market, maybe the tier that you're a part of.
And it's
So,
March 25th, everyone.
yep. So May.
Or sorry, May 25th, 2021.
Yep. So that's generally what you could expect. Again, non-recourse. So that's the biggie on that one. So anyway, that's agency. Going over to bridge, I just kind of went through the terms. I won't rehash that with the floating rate, 30-year, all that stuff. But let's see, with experience, they generally like to see experience as well, especially when you get those larger dollar amounts. So I would say use the agency benchmark for your sponsorship group as kind of a proxy for what bridge lenders will require. They probably have a little bit less, definition around it, and maybe a little bit more flexibility, but just go with that. And similar, I'd say with the personal balance sheets, they want to definitely see some sort of liquidity and net worth. So, but when you deal lender to lender to lender, they all have different standards.
Okay, yeah, for sure. Okay, well, thanks for going over some of those, just basics with our group. Well, I know we have so much more that we're going to touch on next time because, you have a whole career in asset management that I want to go into. But for now, Clay, why don't you give the listeners a way to get in touch with you and anything else that you'd like to share with them?
Yeah, sure thing. So just a reminder, I'm with Old Capital Lending, and so you can visit our website at www.oldcapitallending.com. And my email address is callen, ALLEN, at oldcapitallending.com. And I'm one of those who will put out my phone number as well. So it's 678-357-2631, and happy to provide any further information or answer any questions.
Awesome. Well, I hope you all feel free to give Clay a call, and I'm sure he'd be happy to talk you through any opportunities that you're looking at. Clay, thank you so much for giving us an overview of what's going on in the lending space right now. It's such a critical component of getting these deals done, and really important to keep our pulse on what's going on. So thank you so much. Look forward to having you on again next time.
Thank you, Suja. Appreciate it.